Jerome Powell just shocked the stock market with the potential for a half-point rate increase going forward if inflation cannot be controlled. That sent the stock market off of its highs of the day down to new lows. Speaking before the National Association of Business Economics, he made no mistake that he's going to be more aggressive as it pertains to rate hikes. Now, a lot of traders don't like that. And a lot of people have been calling the Fed's bluff saying, hey, when the stock market starts to crash, you're going to let up on those interest rate hikes. But he's doubling down on it this time. And this isn't the first time he said that. Appearing before Senate, he told Senator Shelby that he was willing to Volcker the economy in order to get inflation under control. And that's their mandate, inflation and low unemployment. They've got the low unemployment under control right now, but now they got to get the inflation. Highest in 40 years. So the market doesn't like it. Market thinks that eventually they're going to let off of the gas pedal in regards to how hawkish they're being. But you got a lot of Fed officials out there today talking and reiterating how determined they are to increase the rates. And if they have to, increase it by 50 basis points or perhaps even higher. And here's the thing about Powell. He likes to broadcast his intentions as mere thoughts or possibilities in the beginning to warm the market up to what he ultimately wants to do. So him mentioning a 50-point rate hike tells me that he sees this economy and the runaway inflation and a much graver threat than what the stock market and Wall Street's perceiving it as being. And after last week's rally that saw the S&P 500 rally over 300 points and recover half of its losses on the year, it's clear the market is not taking it serious like it should be. People are still buying the dip, and you're seeing a lot of that FOMO, especially on Thursday and Friday of last week, where people just continued to pile in. You saw the NASDAQ rising at 2% clips like it was no big deal. And it was a hard week to trade last week from a bullish standpoint, because in order to get in where the reward and the risk was right, you had to get in before the FOMC statement. But the FOMC statement was such a ticking time bomb, or the potential for it, that if you got in ahead of that, you were assuming that everything was going to be well with the FOMC statement, which it eventually was. But not knowing that ahead of time was a big risk to take on. So now you're having more of a reality moment for the stock market where they're saying, hey, we might have to start taking this guy at his word. He continues to repeat that he's serious about getting inflation under control. Now, I don't have a lot of faith in Jerome Powell over the years, okay? I didn't have a lot of faith in Yellen or Bernanke. I think they're all horrible. I think the Fed's horrible. But right now, they don't have much of a choice. This isn't 2018 and this isn't 2020 where they could flood the market with money if necessary. In fact, if they do that this time, they're only exasperating the problems that they're trying to fix. So they can't do that. So that's why the scenario that we're dealing with right now is not the same scenario from 2018 and 2020, because inflation was under control that time. So they could be very dovish when conditions got really bad. They don't have that. They actually have to continue to raise interest rates in order to make things better. And if they do that, Wall Street's going to suffer. Now let's get to the charts here, because there's a lot to go over. First of all, on the SPY, big week last week. You saw price get above the March highs and actually go green on the month. But now it's testing this 200-day moving average despite breaking above the 50-day moving average. 200-day moving average has so far rejected price and has sent shares of SPY back towards its lows of the day. The same thing can be said for the Qs. This time, instead of the 200, which it is way away from, you have the 200-day moving average way up here. The 50-day moving average is what is rejecting price on the Qs. And so far, it's trading very close to the lows of the day. But there has been some improvement. I mean, look at this. You got a potential for a double bottom here. Yes, the Qs went slightly below it, and typically that would be a lower low. But for the most part, after you get the move that we saw on Friday, it essentially confirmed this double bottom. Now, not all patterns that are confirmed are necessarily going to work out in the way that they're intended. You can see today that it's been more of a head fake so far with the breakout on Friday, but now you got the sell-off going right back below this breakout level from Friday. Very careful. In a market where there's a lot of headline risk, we haven't even talked about the conflict in Ukraine. We haven't even talked about rising tensions with China. So I am not optimistic that even with this double bottom, that until we can really get back above this right shoulder pattern here of this head and shoulder pattern that was formed going all the way back to August of last year. This is your head and this is your right shoulder. If we can get above this right shoulder, then I think the bulls really have a case for going back to all-time highs and beyond. But I don't have a strong confidence level that we're going to see that. And remember too, much of the rally that we saw last week was coming because of so much strength out of the Chinese markets with the reassurances from the Chinese government as it pertains to these Chinese stocks like Alibaba, BABA, which managed to in one single day rise 35%. Yes, it's not the biggest stock on the NASDAQ 100, but when you have a stock that is as big as Alibaba is, even after the massive sell-off that it's recently had, can rally over 35%, plus the rallies that you saw in JD and also in Baidu, they're going to have a significant impact on the overall market. I'd also like to encourage you guys to pound the like button and the subscribe button so that you guys can be notified of every one of these videos that I do. Plus, hit the join button down below so you can become part of my YouTube membership and get all my stock market research each and every day. So the takeaway in all of this stuff is to make sure that even though we had a phenomenal rally last week, you still have to manage the risk. A strong rally like what we saw is very common in a bear market. And there's a lot of traders that have never seen a real bear market. They weren't around for 2018 when we sold off 30% in a single quarter. And especially the kinds of bear markets that come from events like 2008 and 2000, they do happen. And we're long overdue for one. And I'm not trying to scare you guys into selling everything you got or telling you whether you should or should not. But what I'm trying to explain to you guys is that there is a lot of risk in the market right now. And these massive rallies are more indicative of a bear market than a bull market. So it doesn't hurt to take some profits along the way, raise those stop losses and figure out how are you going to manage the risk if things get sour again, like what we saw from January, February, and much of March. Again, make sure to pound the like button and subscribe to this channel so you can be notified of all future videos. I do live streams on the Wednesday, so be sure to tune in for that. And let me know down in the comments, what is your plans for the stock market here following last week's rally? Do you think there's more upside? Are you a little bit worried about what Jerome Powell is having to say? Let me know. Thank you guys, and God bless.